Welcome back to the deep dive. Today we're navigating what can feel like a pretty complex financial ocean,
Mhm.
where waves of information and speculation and sometimes just fear crash down. So how do you find your footing? How do you make smart decisions without getting completely swamped? We're diving deep into the wisdom found in intelligent investing principles, mastering market fluctuations.
Oh. And this isn't really about memorizing stock tickers or, predicting the next big thing. It's more of a mission for you, our listener, to gain a shortcut to being truly well informed on what actually drives enduring success in the markets. Things like understanding human behavior, cultivating emotional discipline, and making consistently smart decisions.
And that's exactly the critical point here.
Mhm.
While financial markets can often seem, well, daunting, filled with jargon and the advice that seems to contradict itself,
This deep dive is really designed to equip you with some fundamental insights. Insights that actually challenge some of the most common assumptions you might hold. We want to foster a much more critical, kind of independent way of thinking about your investments, helping you see beyond the surface noise and truly understand what creates value.
okay, let's unpack this right away then. What I found to be the absolute cornerstone idea from the source material. It's a real game changer, I think. The text emphasizes that for successful investing, sound decision-making and emotional control are far more crucial than just having a high IQ or relying on sheer luck. That's a huge statement, isn't it? For someone maybe just starting out or even an experienced investor. Why is emotional control more crucial than, say, raw analytical power or getting lucky?
Well, the real revelation here is precisely that shift in perspective. It moves the conversation away from things you might think are inherent, like, innate intelligence or just good fortune.
Things you can't really control.
Exactly. Things largely outside your direct influence. And it firmly places the focus on actionable psychological discipline and having robust decision frameworks. And these are skills you can absolutely cultivate. Think of it like this. Someone with a genius level IQ who consistently panics maybe sells during market downturns,
Yeah.
only to buy back in when prices are high, while they'll likely underperform an average IQ investor who just maintains discipline,
Yeah.
maintains emotional stability. For you, this is a powerful realization because it means successful investing isn't some secret club you're either born into or lucky enough to stumble upon. It's a skill set built on principles you can master through practice and self-awareness. It's about how you react, not just how fast you process things.
Okay, now one of the most vivid and powerful ideas in this text that really captured my imagination was Mr. Market.
Mm.
I found this incredibly insightful. Could you help us paint a clearer picture?
Uh-huh.
Who is Mr. Market and how does he impact an investor's day-to-day?
Absolutely. Mr. Market is this brilliant, really evocative metaphor. Imagine him as your, let's say, eccentric business partner. Every single day, without fail, he shows up. And he offers to either buy your shares in a private business or sell you his shares at a price he names right then.
Okay.
Sometimes he arrives totally ebullient, wildly optimistic,
Yeah.
talking only about future triumphs. On those days, he'll offer to buy your shares at these exorbitant prices or sell you his for far more than they seem worth.
Right, caught up in the hype.
Exactly. But other days, he's utterly depressed, irrational, fearful. He sees only doom and gloom ahead. And in those moments, he's practically giving away shares for pennies on the dollar, just desperate to unload them. He's always there, always offering prices, but his mood swings. They're extreme and often bear very little relation to the underlying value of the actual business.
So Mr. Market really represents the often irrational, fluctuating nature of the stock market itself. But the source doesn't tell us to just follow his whims, does it?
Precisely. No, the core advice is to view these dramatic mood swings of Mr. Market, these market fluctuations, not as dictates you must slavishly follow, but as pure opportunities. If we connect this to the bigger picture, it completely reframes how you perceive market volatility.
Ah, okay.
Instead of something to fear, something to react to impulsively or let dictate your actions, volatility becomes a potential source of significant advantage for you. When Mr. Market is euphoric, maybe overpaying, you might consider selling some shares at that inflated price. When he's despondent and selling cheap, well, that's your chance to buy valuable assets at a discount. It's about being prepared to act when Mr. Market is at his most irrational, rather than getting swept along by his emotions. This ability to detach, to act independently, that's a hallmark of intelligent investing.
So if Mr. Market is indeed so unpredictable, and we kind of know our own investor type, how do we actually put these insights into practice? Our source offers some really bedrock strategies, starting with different approaches investors can take.
Yes, the source clearly outlines two distinct paths investors can choose. First, there's the defensive investor,
Ah.
often synonymous with a passive approach. This individual prioritizes minimizing effort, managing risk, and seeking steady, long-term growth without a lot of day-to-day fuss.
Okay, hands off mostly.
Pretty much. Think of them as someone who builds a robust, well-diversified portfolio and largely lets it grow over time, maybe rebalancing periodically, but avoiding frequent trades based on market sentiment. Their goal is often capital preservation and, reasonable returns with minimal stress.
And then on the other side,
You have the enterprising investor or
yeah,
the active investor. This person is willing to put in significant time and effort. They're actively researching, analyzing.
digging deeper.
Exactly, potentially uncovering undervalued assets that the broader market might have overlooked. They thrive on that intellectual challenge, finding those hidden gems. Now, this path requires a deeper understanding of businesses, industries, financial statements.
Mm.
It's definitely more demanding, but it also holds the potential for higher returns if, and it's a big if, executed skillfully.
Understanding these distinctions feels really important. It's not about one being inherently better than the other, is it?
Not at all, not better or worse, just different. It's really about alignment. This distinction helps you, the listener, identify which approach might best align with your own financial goals, your available time and energy, and crucially, your temperament.
Right, your personality almost.
Absolutely. Are you someone who enjoys deep research, analyzing company reports, seeking out opportunities the market might miss? Or do you prefer a more hands-off approach, prioritizing stability, broad market exposure, minimizing active decision-making? Knowing yourself here, your strengths, your limitations, your emotional tendencies, it's just as important as knowing the market itself. It dictates which tools and strategies will genuinely serve you best.
All right, let's move from these broader investor types to some concrete, tangible strategies. Things any intelligent investor, regardless of their path, should probably embrace. One big one that immediately comes to mind is diversification. It's often talked about, but the principles really underline its importance.
Oh, absolutely. Diversification is foundational. Think of it like tending a garden, right? You wouldn't plant just one type of crop, would you?
No, definitely not.
Because if that single crop fails due to disease or bad weather, your whole harvest is lost. Similarly, in investing, diversification means spreading your investments across different assets, stocks, bonds, maybe real estate, different industries, different geographies. The idea is simple. If one investment performs poorly, others in your portfolio can still thrive. It smooths out your overall returns and significantly mitigates risk. It's not about eliminating risk entirely, that's impossible, but about reducing the impact of any single negative event.
That makes perfect sense. And another bedrock strategy mentioned is fundamental analysis. What does that truly entail for an intelligent investor? What does it look like?
Well, fundamental analysis is about truly digging into a business, evaluating its intrinsic value based on its assets, its earnings power, its management quality, its future prospects, rather than just chasing hype or, trending stock prices.
Looking under the hood.
Precisely. You're essentially asking, what is this business really worth, independent of what the stock market ticker says today? This involves looking at financial statements, competitive advantages, industry trends, management effectiveness. It's a deep dive into the underlying economic reality of the company. It's about becoming a business owner in your mindset, not just a stock trader reacting to blips on a screen.
And building on that, the source really emphasizes something called the margin of safety. This sounds almost like a defensive strategy in itself. Why is it so critical? And, is it hard to find in practice?
The margin of safety is, well, it's not just a good idea. It's really presented as a foundational concept, crucial for mitigating risk and building resilience into your portfolio. It simply means buying an asset, whether it's a stock or a bond or even real estate, for significantly less than what you've conservatively calculated its intrinsic worth to be.
Okay, give me an example.
Sure. Let's say your thorough fundamental analysis suggests a company is truly worth, say, $100 per share. But due to market sentiment, maybe Mr. Market's feeling down, its stock is currently trading at $70. That $30 difference, that's your margin of safety.
I see. The buffer.
Exactly. You're building in a cushion, a buffer, against potential errors in your own analysis, which happens, or against unforeseen negative events that might slightly reduce the company's value down the road. It protects you from the unknown unknowns to some extent. And this raises an important question for you. How can you consciously build this kind of protective layer, this resilience, into your investment approach, rather than simply hoping for the best? It requires patience, definitely, and discipline, waiting for those opportune moments when Mr. Market is overly pessimistic. They don't come along every day.
So what does all this mean for how we fundamentally think about investing? I mean, the source then introduces a truly provocative idea, doesn't it? One that directly challenges a lot of conventional academic wisdom. Traditionally, it's often taught that risk and reward are always correlated.
Right, the higher the risk, the higher the potential reward.
Exactly. Meaning, to get higher rewards, you must take on higher risks. But our source asserts that astute investors can actually find situations where they achieve high reward with lower risk. That sounds almost too good to be true. What's the catch? Is it really that straightforward to spot these undervalued assets, or does it require a particular kind of market environment?
That's a brilliant question, and it really gets to the heart of what intelligent investing truly is, according to this source. The catch, if you want to call it that, is that it requires precisely the kind of disciplined approach we've just been discussing. This seemingly contradictory idea, high reward with lower risk, it's possible. Not through magic or blind luck, but by diligently identifying mispriced assets.
Mispriced. Okay.
Yeah, these are businesses or investments where the market, perhaps in one of Mr. Market's irrational moods, has priced them well below their true intrinsic worth. It's about distinguishing between genuine business risk and market price risk. They aren't always the same thing.
Explain that difference a bit more.
Okay, so a perfectly solid, well-run company might see its stock price tumble because of some temporary bad news, or maybe just a broader market panic.
Right.
Not because its fundamental business prospects have dramatically changed for the worse. For an enterprising investor, this creates an opportunity. The perceived risk, judged by the falling stock price, seems high, but the actual business risk hasn't necessarily increased proportionally. So this creates an opening to buy high value at a low price. By spotting these opportunities through that thorough fundamental analysis we talked about,
And applying the margin of safety.
and applying that margin of safety, yes, you're essentially buying something valuable on sale. This inherently lowers your risk because your cost basis is lower, while preserving the potential for significant upside as the market, hopefully, eventually recognizes its true value. Now, it's certainly not always straightforward. It demands independent thought, rigorous analysis, often going against the crowd, but it absolutely encourages you to critically question those widely accepted notions and to seek out those situations where value is misunderstood by the broader market rather than just following the herd.
Okay, so to quickly recap what we've covered in this deep dive, we talked about how sound decision-making and emotional control are paramount for investing success, overshadowing even IQ or luck. We've introduced you to Mr. Market, that fascinating metaphor for the market's irrational fluctuations, which we can and maybe should view as opportunities rather than threats. We then distinguish between defensive and enterprising investor types, hopefully helping you identify your own path, or at least think about it. We dove into key strategies like diversification, fundamental analysis, and that critical concept of a margin of safety. And finally, we challenged that conventional wisdom about risk always equaling reward, showing how astute investors, according to the source, can indeed find high reward with lower risk by diligently identifying undervalued assets.
Right. And maybe for a final thought for you to mull over, consider how this powerful idea, finding high reward with lower risk through diligently identifying undervalued assets, it doesn't just apply to stocks and bonds. This principle, this way of thinking, it extends far beyond finance, really. It's about cultivating a discerning eye to identify overlooked opportunities in many aspects of life.
Interesting.
Perhaps it's an undervalued skill in your career that others ignore, but you can develop it into a significant advantage. Or maybe an undervalued community project that, with your effort, could yield immense returns for everyone involved. It's about learning to see beyond the immediate fluctuations, the surface level perceptions, and truly recognizing intrinsic value where others may not. It encourages you to apply that same critical, independent thinking to almost everything you encounter, seeing opportunities in places where others might simply see chaos or, well, fear.
A truly powerful way to look at the world indeed. Thank you for joining us on this deep dive. We hope you feel much better informed and perhaps a little inspired to look for those undervalued assets in life as well as in the market. We'll see you next time on the Deep Dive.